Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. July 7 U.S. Market Peripheral Notes. This video presents a direct informational narration of the source document. So today we're unpacking these notes to really understand a major, kind of head-scratching market anomaly.
Okay, let's dive right into this. We're looking at a pretty fascinating paradox that happened on July 7th. Imagine this, a market where absolutely record-breaking corporate profits were just announced, right? You'd expect a massive rally, but instead, boom, it triggered a severe technology sector sell-off. So what we have here is basically a macroeconomic detective story. As we go through the source document, we're going to map out exactly how geopolitical shocks, shifting institutional funds, and changing narratives completely overshadowed what, by all accounts, should have been incredibly bullish fundamentals.
Here's the roadmap for how we'll uncover the mechanics behind this sudden drop. 1. The perfect macro storm. 2. The semiconductor sell-off. 3. AI and storage shifts. 4. The sector rotation game. And finally, 5. Smart portfolio strategy.
Starting off with Section 1, the perfect macro storm, focusing on geopolitics and yields.
So, the first major negative catalyst actually hit the market before the opening bell even rang. A sudden geopolitical shock happened when Iran fired missiles at 3 cruise ships passing near the Strait of Hormuz. Now, thankfully, there were no casualties, but this event instantly broke a fragile ceasefire agreement. The immediate reaction from the market? Well, international oil prices surged, and crucially, the 4-year U.S. Treasury yield spiked, pushing right past that 4.5% red line. And historically speaking, crossing that 4.5% threshold, it acts like a wet blanket. It heavily suppresses tech stock valuations and causes the broader market's risk appetite to cool down really sharply.
But now, check out this staggering contrast. The second major event was an earnings report that absolutely should have sent the market flying. Samsung Electronics reported a Q2 pure profit of $58.4 billion. I mean, wow, that is a massive 19 times year-over-year increase. To put that into perspective, this single quarter's profit actually exceeded their combined profit for the entire past 3 years combined, literally making them the most profitable company globally at that very moment.
But here's the catch. This phenomenal, totally expectation-beating performance, it didn't drive the AI sector up. Instead, it triggered a massive sell-off that just spilled over into the broader U.S. market. The PHLX Semiconductor Index gapped down right at the open and fell straight through its 50-day moving average. For you chart watchers out there, you know this signaled a severe technical breakdown of its previous uptrend.
This brings us to Section 2, the semiconductor sell-off, looking at myth versus reality.
This part brilliantly illustrates the total disconnect between financial media noise and actual market mechanics. Let's look at Intel, for example, which plummeted 9.7% that day. The narrative, the excuse floating around, was this fear that Samsung's plans to mass-produce 1.4 nanometer process chips by 2029 would steal high-end orders. But if you scratch beneath the surface, that explanation is actually pretty far-fetched. The reality of this drop is that the semiconductor sector was just facing concentrated institutional position reductions. It was a classic phase of institutional deleveraging, not some sudden deterioration of fundamentals. Basically, both institutional and quantitative trend-following funds headed for the exits at the exact same time. Intel had racked up massive gains over the past year, making it a prime target for funds that were just eager to cash out those profits.
So the really crucial thing is watching what happens next. Technical analysis from the source document indicates that if the sector can't reclaim a position above that 50-day moving average within 2 to 3 trading days, the current correction is going to seek much deeper support levels. The next major catalyst to keep an eye on are the upcoming earnings reports from TSMC and ASML. Those are going to have a far greater impact on the U.S. semiconductor sector than Samsung did, for sure.
Moving right along to Section 3, AI and storage shifts, specifically reallocations, not downturns.
The storage sector took a really heavy hit too. The DRAM storage ETF gapped down 6.5%, breaking its 50-day moving average, and leaders like Micron suffered heavy losses. But again, we've got to look at the true nature of the drop here. Market mechanics show this was essentially a margin call stampede, a deleveraging from high levels that temporarily wrecked the technical charts. Think of it as a reallocation of capital, not a real turning point in the industry's prosperity. The fundamentals haven't actually changed. Global high bandwidth memory, or HBM, demand remains incredibly strong. A big reason for the drop was actually funds just returning to their original positions after the completion of SK Hynix's US listing. It's a liquidity drain that's super comparable to the capital shifting we saw in the space concept sector right before SpaceX listed.
Let's break down the underlying shifts happening in the AI sector right now. The valuation logic for core AI hardware, like GPUs and HBM, is actively transitioning from a supply shortage phase directly into a production expansion phase. And because of that, the shortage premium that previously propped up those sky-high AI valuations is gradually fading. On top of that, the massive AI options craze that drove the Nasdaq to record highs is really cooling down. We're seeing tech stock volatility return to much more normal levels. Those previously overly crowded trades are unwinding. And ultimately, this unwinding is actually a long-term positive for the market. It just needs a little time to digest.
Now for Section 4, the sector rotation game. Where did the money actually go?
The intraday shifts were incredibly rapid, which really highlights the intense sector rotation happening. In the morning, as hardware was selling off, capital rushed for a safe haven in the software sector. That briefly made it the S&P 500's best performer, with ServiceNow jumping 2.6%. But software later gave up those gains because of the rising oil prices and treasury yields we talked about earlier. By midday, energy stocks took the baton, and oil became the top-performing sector. Meanwhile, NVIDIA did something fascinating. It opened lower, dropping over 2%, but completely reversed course to turn green by the close. The market essentially used NVIDIA as a macroeconomic hedge and a safe harbor during the semiconductor shakeout. And through all this wild rotation, the S&P 500 still managed to hold its 5-day moving average at the close, forming a small doji star on the charts.
We also saw some wild action in specific individual stocks. Rivian experienced a brutal 18.12% drop. The company announced they were issuing 75 million Class A common shares to raise about $1.51 billion. This was to meet equity funding obligations for a U.S. Department of Energy loan. But the paradox here? Rivian's fundamentals are actually solid. Their projected Q2 revenue of $1.55 to $1.65 billion beat the $1.45 billion estimate, and their cash reserves went up to $5.3 billion from Q1. The drop happened largely because EVs just aren't the market's hot theme right now, and investors panicked over the short-term pressure of equity dilution. In other index news, SpaceX dropped 6.8% upon its Nasdaq 100 inclusion. Wall Street is expecting some severe volatility to follow, but since it has a low weighting in the Nasdaq 100, the impact on the broader index is pretty limited.
Finally, we arrive at Section 5, Smart Portfolio Strategy for navigating fast rotations.
We're currently in a market environment where the broader index might not move drastically, but sector rotation is happening at absolute breakneck speed. That makes trading individual stocks incredibly difficult. Investors who are heavily concentrated in semiconductors or leveraged ETFs can easily wipe out months of profits in just a few days. Talk about incredible anxiety, right? The thing is, stock prices reflect market hype and valuation levels, not always direct corporate profitability. There is simply no myth of perpetual upward movement. Institutional money is constantly changing its narrative logic, easily turning retail traders into casualties of the game. So, to survive this environment, the source document recommends a specific allocation strategy. Keep at least 60% in index ETFs like QQQ, limit individual stock exposure to under 30%, and strict limit leveraged ETFs and options to no more than 10%. This setup lets you capture the long-term gains of the US bull market without a single mistake totally ruining your personal finances.
There is a really stark warning here against taking an all-in, stud-style investment approach. A lot of people envy highly publicized cases, like that ByteDance employee who took out a loan to go all in on expiring options and walked away with $30 million. But guys, this is a classic case of survivorship bias. Behind that one flashy headline success are countless unseen, grim realities where families heavily bought expiring options, lost their entire principal, and fell into severe debt.
For ordinary families in their 30s and 40s who have elderly parents and young children depending on them, bearing this level of risk just isn't worth it. When it comes to investing, one must pursue the philosophy that slow is fast. So the big question you have to ask yourself as we watch these wild market rotations is this: are you building resilient, long-term wealth for your family's future, or are you just playing a high-stakes casino game?